Welcome to the Purposeful Wealth Podcast.
Welcome to the Purposeful Wealth Podcast. And today we are going to be considering the subject of dividends. And the title for this episode is Please Don't Chase Dividends. Readers of the Sunday papers, the Sunday's financial pages will be familiar with the dividend chasing stories that pundits and some fund managers just love to peddle. They generally focus on high dividend paying shares or income funds that focus on these shares. And the thought that one can take an income from a portfolio without the need to sell shares can feel, at least superficially, appealing to some. This is sometimes known as taking natural yield from a portfolio. And in theory, it all sounds great. Wouldn't it be great that you have your money invested and you enjoy the natural yield from these shares? But if you dig a little deeper, it quickly becomes evident that a portfolio constructed from a bottom up dividend driven approach is unlikely to be the most optimal approach, and will certainly contain risks that may not be fully appreciated. The first point to note is that you cannot have your cake and eat it. If a company pays out a high dividend, that money cannot be reinvested by the company to deliver higher future earnings, which in turn drives share prices. In other words, the present value of future cash flows of a company. So with higher dividends today, you forgo tomorrow's growth in the share price, essentially. In theory, the dividend policy of a firm should make little difference to its total return. By total return, we mean dividends plus share price growth or share price appreciation. And the second point to note is that different sectors of the economy tend to have different average dividend payout strategies. So, for example, technology companies tend to reinvest most of their cash flows into product development and attaining greater market share, whilst energy companies, on the other hand, which tend to operate in a more mature industry, they may not be able to find projects in excess of their cost of capital and may return money to shareholders via dividends. So chasing dividends tends to end up in large sector bets away from the overall market. The third point to note is that because each equity market reflects the companies listed on it, large sector differences do exist between markets. For example, the UK has materially less exposure to technology companies compared to the United States, but enjoys or has higher weightings to energy companies, for instance. As a consequence, the UK market has higher dividend yield than the US market. So a dividend-driven approach will likely overweight the UK and other high-yielding markets relative to other low-yielding markets. And if we look at the average dividend yield of the 10 largest global markets by size between the years 2015 and this year, we can see that Switzerland leads the way, followed by Australia and then the UK. The final points worth noting are, within each market, dividend payments are often concentrated in just a few shares, resulting in what we would call share concentration risks. And higher dividends tend to describe value companies, which are less healthy companies with higher expected returns, potentially inadvertently skewing you as an investor and your portfolio towards higher expected risks. So If you have bonds in your portfolio chasing higher yields from lower quality bonds, or the other way to look at it is lower quality borrowers, this simply adds equity-like risk to your portfolio. The higher the yield, the riskier the borrower when it comes to bonds. But that story is for another day. A sensible alternative approach to taking income from a portfolio, and instead of chasing dividends, is to think of investing, or to think of returns on a total return basis, where as an investor you're agnostic to taking dividends or selling shares to deliver the capital you require. This is certainly the way that pension plans and endowments tend to draw their income. And by doing that, it really does allow you as an investor to maintain the structural integrity of your portfolio, and to avoid company or sector or market bets in the pursuit of higher dividend yields on portfolios. My advice is always don't chase the dividend illusion. Instead, look to have a well diversified portfolio that includes companies that pay lower dividends as well as companies that pay higher dividends. And over time, you will find that your total return hopefully should support the income that you enjoy from your portfolio. So, short episode this time round, but thank you again, as always, for listening to the Purposeful Wealth podcast.